Hello there everyone, today's video is all about furnished holiday lets, which are a type of buy-to-let property business that landlords may have. So if you are in this situation or contemplating being in this situation, have a listen to this video because there are various tax reliefs afforded to so-called FHLs, furnished holiday lets, that normal buy-to-lets don't have. So what are they? Well, let's dive in. First of all, HMRC treat a furnished holiday let almost like what we call a quasi trade. So normally buy-to-lets, even though buy-to-let portfolio is a business, as far as HMRC is concerned, it doesn't meet the requirements generally for 99 out of 100 buy-to-let portfolios of being what we call a trade. If it's a trade, you get more tax reliefs. But if it's just a business, you don't get these reliefs. And the default position for HMRC is that buy-to-let rentals of properties is not a trade, even though it may be a business, and hence there are certain reliefs in the tax world that are denied. However, if you have FHLs, there are these certain tax reliefs. So what are they? Well, before we look at that, what are the criteria? What is an FHL, a furnished holiday let? So it is a property that is available to be let for 210 days of the year, so that's about 30 weeks. It has to be actually let for half that time, so for 105 days of the year. We're talking about a tax year, 6th of April to the 5th of April, 105 days. Continuous let no more than 31 days, although there are some exceptions. So you get the gist. It's for short-term lets. It's not for some tenants in a typical buy-to-let who could be there for years. This is hence the reason holiday in the furnished holiday lets. So you've got holiday cottages, properties that you let out with multiple people coming and staying. Hopefully you can qualify for these FHLs. Look at the days. How many days is it available to be let? How many days is it actually let? So, assuming it qualifies as an FHL, the first thing, qualifies for pension tax relief for relevant earnings purposes. Let's say that you are a landlord, buy-to-let properties that are not FHLs, just regular buy-to-lets. And let's say you are a director of your own company, so most of your income for income tax purposes is in the form of dividends and profits on your buy-to-let. Both of those, you cannot frank pension tax payments. What we mean by that is that both dividend income and buy-to-let property income are not deemed to be called relevant earnings for pensions, so you can't put into a pensions to offset the tax on those particular types of income. So that's dividend and buy-to-let profits. Yes, you may say, well, that's not a problem because if the guy's got his own company, he can do a pension contribution in the company and get CT relief, but just assume the company has not got a lot of cash sloshing around, so he can't do that either. So in this case, you can't get any tax relief for putting into your pension. Now, with FHLs, the profits on that property, which by the way, could be exactly the same profits as a normal buy-to-let, it's just that the building qualifies as a furnished holiday let, the profits can qualify as relevant earnings. So in this case, the landlord, the owner of the furnished holiday let, can put in a chunk into his pension because he's got the profits to cover it, which you wouldn't have if that was a regular buy-to-let. So that's the first thing. Qualifies for pension tax relief because it's deemed to be what we call relevant earnings. The next one is no interest restriction. Now this is a biggie. So as you know, for several years now, there's been interest restrictions for landlords where you cannot claim tax relief on the interest payment to the mortgage company, the interest element. It's been denied as a tax break. So what tends to happen now is that you can only get a tax reducer, which is capped at 20%. No good if you're a 40% taxpayer. But that's been in now for a few years. When it was introduced, it was tapered down. But right now, the full interest relief has gone. So reduction at basic rate level, in certain circumstances, it's even worse than that. So if you have an FHL, that interest restriction goes. It's not applicable. You get full tax relief on the interest on your mortgage, on your furnished holiday let mortgage, that you wouldn't under a regular buy-to-let. So that's really good news. So no interest restriction. Next one, capital allowances. So capital allowance is just tax world jargon for tax write-off, depreciation of kit, of assets. Now, being specific, and again coming back to normal buy-to-lets, because we have to compare the two. If you're a landlord on a normal buy-to-let, the only thing you can claim what we call capital allowance on, which is tax relief, tax write-down, is things used as the machinery for your business as a landlord. So let's say you've got industrial vacuum cleaners or something like that. The cost of that you can write off. All the stuff that you furnish a house with, white goods, tables, chairs, curtains, carpets, the rule is that you cannot get tax relief on the initial purchase. You can only get tax relief when you replace it. So the first spend is what we call dead spend, no tax relief. Then when you come to replace white goods, furniture, that's when you get tax relief. It's called RDIR, Replacement of Domestic Items Relief. Now, in the furnished holiday lets world, you can claim capital allowances on all the stuff that normal buy-to-let landlords have to claim RDIR on. In other words, if you have a furnished holiday lets, you get immediate tax relief on the initial spend. So like I said, if it's a normal buy-to-let, the initial spend, dead spend, no tax relief. FHL, it qualifies. It qualifies for capital allowances. So you get tax relief on the first acquisition of the white goods, the furniture, all the stuff you kit out the house with. So that's terrific. That is a really good tax break. Trumps normal buy-to-lets. Right up there with interest. No interest restriction. What else? What else on FHLs? Well, the story continues. It's not all great news. If you have a decent FHL portfolio, your turnover gets to 85 grand, you've got to register the business for VAT. Now, if you've got a normal buy-to-let portfolio, even if you're turning over several £100,000, you never have to register for VAT because it's deemed to be an exempt supply. And if you make an exempt supply for VAT, you never have to charge VAT. But on FHLs, you do, if you get to 85 grand. So just watch out for that. I would say most people with FHLs in their portfolio will never even get to that level of turnover. Remember to keep it separate. If you have a mixed portfolio, FHLs and Resi, you don't amalgamate the turnover to say, am I going to hit 85? You keep them completely separate. And if your FHL turnover goes above 85, that's when you register for VAT. BPR, business property relief, which is an inheritance tax relief. If you have a portfolio of buy-to-let properties, when you die, that forms part of your estate for tax purposes. But if you've got a portfolio of FHLs, like I said, because it's treated as this quasi-trade from HMRC, this is another one of the tax relief that gets afforded to it rather than a regular buy-to-let. So business property relief falls out of your estate. Very useful tax break. Next one, again, putting a bit of a dampener on things, but this is not so much a tax break, but something that's similar to buy-to-lets. No loss set off against general earnings. So if you have, let's say you have a self-employed business and you're also an employee, if you're making losses on your self-employed business, you set those losses off against your employed income to reduce your tax bill. You cannot do that with property losses. If you've got property losses and you've got other income, employment income or dividends, you cannot set the property losses against that other income for regular buy-to-lets or for FHLs. Like I said, there's all these advantages that FHLs have over normal buy-to-let, but in this case, it's exactly the same for losses. If your FHL makes a loss, cannot set it off against other income. However, you can carry it forward to utilize against future profits. So all is not lost on the losses. They do have value. They can be used in the future to set off against future profits of that FHL business. But there's no what we call sideways loss relief to set off against general income. Here's another great tax break on FHLs, capital gains tax. If you sell any properties in a regular buy-to-let property portfolio, you're going to pay 28% capital gains tax, assuming you're a higher rate taxpayer. And I'm assuming that, again, even if you're a base rate taxpayer, again, would trip you into higher rate. So let's just say you're going to pay 28% capital gains tax when you sell a buy-to-let property. But if you sell a furnished holiday let, you're going to get entrepreneurs relief, or business asset disposal relief as it's called. You know, I keep calling it entrepreneurs relief, but entrepreneurs relief, as many of you know, means low rates of capital gains tax, 10%. So that's one heck of a difference. Your furnished holiday let, you sell it, you're only paying 10% capital gains tax. Normal buy-to-let, when you sell, 28%. Terrific capital gains tax break. Speaking of capital gains tax, some more CGT breaks. FHLs qualify for rollover relief. Now, what is rollover relief? Rollover relief is when you replace assets like for like. So let's say you sell your furnished holiday let, you've got a capital gain, but then you buy another furnished holiday let. You can defer the gain, so you don't have to pay capital gains tax. The gain gets rolled over into the new property, the new FHL property, and then you pay capital gains tax at the back end when that's sold. And again, you could keep rolling that over. So rollover relief is a tax break available in the CGT world, not available to regular buy-to-lets, but it is available for FHLs should you choose to buy another one if you sell the first one. And another CGT relief, holdover relief. So this is otherwise known as gift relief. If you gift your furnished holiday let to someone in your family, not your spouse, because that's free from capital gains tax anyway, but if you gift your furnished holiday let to one of the kids, you can claim gift relief, which means that, again, there's no capital gains tax for you to pay on that gift like there would be if it was a regular buy-to-let. Again, we keep coming back to compare with the regular buy-to-lets, but on furnished holiday lets, you gift it to someone, no capital gains tax, because that capital gain is rolled over and the person who received it will ultimately pay it if they then sold it. So, again, exclusive to FHLs over buy-to-lets. So just an overview there on the tax benefits of having furnished holiday lets over regular buy-to-lets. Now, yes, you may say, look, I like having a tenant in situ they've been there for years. I like the regular knowledge that they're going to pay me, so I don't want to get into the furnished holiday world because it could be seasonal and I might not hit the 105 or the 210, and also there could be, I'm not guaranteed. Listen, I get it. But if you are thinking about getting into that space, or you're already in there, do consider all these tax breaks. You may already have an FHL and you've been running an FHL for years. And yes, you might know one or two of these points, but not all of them. Did you know that you can get holdover relief or rollover relief? Or if you're going to sell it, it's only 10%. The interest restriction, that's a big one. Just in the last couple of years, that could save you thousands of pounds in tax. The fact that there is no interest restriction. So do have a look at FHLs, either if you're already in that space or you're a budding landlord thinking about getting into property for the first time. FHLs, because they really do trump regular buy-to-let. So if you like this video, please do subscribe, and as always, I'll see you soon.